I'm Mona Corey, owner of Tucson Tax Team and an enrolled agent, licensed by the federal government and an expert in taxation. I also own real property in Rocky Point, Mexico, and I have firsthand knowledge on both the U.S. and Mexico tax requirements. I've made a series of videos about this topic, and I hope you enjoy them. So today I'm going to discuss renting your second home. This is a home that you rent for more than 14 days a year, because if you rent it less than 14 days, you don't even have to report that income to the IRS. If you rent your unit for more than 14 days, then we have to decide how your rental is going to be taxed, which classification. We figure that out by calculating how many personal days you've used it during the year and how many days you've rented it. Those two items will decide if you're a hobby rental or a vacation rental. Counting personal days, you have to pick your days and your spouse's days. Any immediate family member who uses your property, even if they pay you. So your children, your parents, your siblings all count as immediate family members. If you rent your unit for less than fair market value, you let friends use it for a lot less money, you have to count those days. And you also have to count charity. If you donate it to charity, it's a double whammy. Not only can you not deduct the expense as a charitable donation, but you have to count the days you've given it to the charity as into your personal days. So I have an example for you. Sally owns a vacation home and she visits her property every 3 months for a long weekend. So we have to count all 12 of those days she's at the property. But actually when she's there, one day every single quarter, she's actually spending predominantly the whole day working on her property, doing repairs, doing maintenance. And so we don't have to count those 4 days. We can subtract them off of her personal days. Her sister actually used her home for free for 4 days. We're going to include those days. And her brother actually paid her to use the property, fair market value rent, but because he's an immediate family member, the IRS says she has to also count the 2 days that he rented the property. Sally's cousin came, and because he's not considered an immediate family member, we don't have to count his days in our calculation. Her best friend used the property and she gave her a deep discount, pretty much just charged her for cleaning and for utility costs. So unfortunately she is going to have to include those 4 days her friend used the property. And then lastly, Sally donated her property to a local charity who auctioned off the property, and she has to count those days in. So when we count all of Sally's personal days, it comes up to 21 days. So we still don't know which classification Sally's rental falls under. We know how many personal days she uses, but we also still need to know how many rental days she had during the year. The IRS has a rule called the 10% rule. That means that Sally cannot use her vacation home more than 10% of the days it's rents during the year, or a minimum of 14 days. Otherwise, she doesn't get the preferential vacation rental treatment. So a hobby rental is the worst case scenario. You have to report all of your income on Schedule E, but all of your expenses can only be used to offset that income. You cannot have a net loss as a hobby rental. If you have a net loss, it's just lost. You can't carry it forward, can't do anything with it. You are able, with a hobby rental, to take your personal portion of your qualified mortgage interest and your property taxes over to your Schedule A for that deduction. But that's your limit on deductions for a hobby rental. Now let's take our second example. So Sally rents her home for 20 days per month or 240 days per year. Now she can use her home personally for 24 days. And since she only used it for 21 days, she qualifies for preferential vacation rental status. Vacation rental, we still include all of the income on the Schedule E, but the expenses are allocated between personal and business, and if there's a net loss, they can be used to offset passive income. Can't be used, unfortunately, to offset ordinary income. Because most vacation rentals are for less than 7 days, minimum stay of less than 7 days, they don't qualify for that $25,000 special rental allowance that you usually get in the United States when you rent your property on a month-to-month basis. But those losses can be used again to either offset other passive income you have can be used to offset future income you'll have on the vacation rental, or they can be used when you go to sell the property. You'll be able to use them that year. They're going to release that year and they'll be used in full, and they might be able to offset some of the capital gains on the year of sale. All your operating expenses for both your hobby and your vacation rental do need to be allocated between your personal use and your business use. The tax courts have actually come up with better allocation methods than the IRS. Operating expenses are things that you're going to have no matter what, if you rent your property or not. Now, there's direct expenses that you don't have to prorate. So those would be things like the management commissions for renting, maybe some renter's insurance over and above your property insurance. Things like that would be direct expenses. Again, the losses unfortunately are limited to other passive income you have, or they're carried forward until you have passive income or you sell the property.